This is BBC Radio 4. Now it's You and Yours with Peter White.
Hello, welcome to Radio 4's Consumer Programme. Now, are people who use peer-to-peer websites to invest their money taking a bigger risk than they realise? Now, these websites link up borrowers or companies with savers who want a better return than they get from the banks. It's rather like financial matchmaking. But with peer-to-peer lending, your money is at risk. Well, Andrew Tyree, who's chair of the Treasury Select Committee, has written to the Financial Conduct Authority saying,
whether, and if so to what extent, investors would benefit from stronger consumer protection now needs careful thought. Poorly informed investors may be left with a false sense of security about the balance of risks versus returns.
And Andrew Tyree is not alone. He is Lord Turner, the former boss of the old Financial Services Authority, speaking back in February.
I strongly suspect that the losses on peer-to-peer lending, which will emerge within the next 5 to 10 years, will make the worst bankers look like absolute lending geniuses. You cannot lend money to small and medium enterprises in particular without somebody going and doing good credit underwriting. This idea that you can just automate that onto a platform, I think it has a role to play, but I think it will end up producing big losses.
Lord Turner. So just how concerned should a peer-to-peer investor be? Well, P2P all started more than a decade ago with a platform called Zopa, which now has around 60,000 lenders and just over 150,000 borrowers. Well, I've been speaking to Roger Gewolb, who's founder of the Campaign for Fair Finance. But first, here's Jaideep Janardana, who's Zopa's chief executive.
A typical borrower is in the mid-30s and have a stable credit history as well as a stable income. And they are typically looking to borrow money for either buying a car, improving their home, or consolidating existing debt that they have.
And the lenders?
We have got two groups of lenders. One are slightly older, average age of 50, 55, and they are looking to really plan for their retirement. We also have younger families who are trying to save for some life goals. So they think of buying a house and looking at how to grow their deposit.
But isn't peer-to-peer effectively lending your money to complete strangers in return for higher interest rates than offered by the banks? Who looks out for the consumer if it all goes wrong?
So we have been around for 11 years, and one of the things we have done is being very transparent about our performance. So the leading platforms in the UK have made their entire loan books public, and that transparency is the biggest source of credibility for us as an industry. And we also make sure that our communications, we make it very clear that their capital is at risk and they are not protected by the FSCS compensation scheme.
So Roger Gewolb, what's not to like about that? What are your worries?
Having reviewed their materials, we do have some concerns that need to be answered. What is the risk here, as you've said? Are the economics correct? Secondly, is the business model such that it encourages very, very accelerated and potentially dangerous growth? And thirdly, who in the world is policing all this?
OK, some people are doing all right out of this and making money out of it. Jonathan Friedman, for example, we can hear, he's an accountant.
About 3 to 4 years ago, I invested £25,000 in RateSetter. I've had quite a reasonable return. The money went into a series of loans yielding on average about 7.5%. I've had no problems. The loans have all been repaid on time. I'm aware that there are more risks, although this is quite a substantial sum of money, £25,000. It's not an amount of money I would care to lose, but it's an amount of money for which I guess I'm in the fortunate position of having the risk appetite to put that part of my savings into something of that sort.
So Roger Gewolb, Jonathan's investment went smoothly. Are there actually examples of people who've lost money in the UK?
Well, we haven't got that far yet to people that we're aware of losing money. We've got to ask ourselves, if we put £25,000 in a bank, it's guaranteed by the government. If we put it into a P2P company, how do we know that the people that they are apparently matching us with aren't lying about their ability to repay? What if they don't repay?
So, Jaidev, there may not have been scandals yet, but what Roger is suggesting is that this is an accident waiting to happen.
Well, I'll have to disagree. I mean, the FCA is definitely policing and regulating us and have been regulating us since April 2014. They do investigate how we communicate to our lenders or investors and make sure that we make it clear the risks that they're taking. They do also investigate some of the affordability checks that we have and our credit checks that we have, and to see that they are appropriate and if we are practicing what could be called as responsible lending. In addition, we have been very transparent about our performance and make sure that we actually make that publicly available so that people can be their own judge.
But the problem surely is that you don't get money back if everything goes wrong, if it goes pear-shaped, do you?
So yes, your capital is at risk. Our target customer base, as we call, is prime and super prime customers with very good credit histories, customers who can get a loan anywhere else. And our asset performance and our risk performance actually bears that out.
So, Roger, JDev is saying there is quite a lot of oversight. What do you think should happen and who should do it?
We'd very much like for this to work, but at the same time, people were saying the same things about the subprime mortgage crisis before it went pop. These P2P lenders don't actually hold these loans on their books like a bank. They sell them off. I would like to make one point about this publishing their loan books online. I have to say that, with respect, we find that slightly disingenuous in the sense that I don't want to look at 80 gigabyte of loans, every detail about every loan. I want to look at the report that they give to the institutions that give them money. Putting up a loan book of Peter White's loan, your address, your amount, your monthly payment, and having 100, 250,000 of those for you to read is, to my mind, like going to your doctor who says, Peter, you've got a problem with your back. And you say, oh, my, well, what is it? And he hands you the x-ray, says, here, go home and look at this. We need either the FCA or the Bank of England because, after all, these are just bank deposits.
Let JDev have a word here. What Roger is suggesting here is that the model itself is dangerous.
So I could not agree more with Roger's point where he says that it needs government oversight. So we actually welcome government oversight. We have lobbied for it, and we are working with the FCA today to make sure that they can have transparency to what we do. In addition to that, we are also working within the P2PFA, which is a self-regulating body, to set standards that are actually above and beyond what the regulator asks us today to do.
Roger Gewolb, I get the impression that you won't be lending your money in that form anytime soon.
Well, I'd like to say that I would, but at the moment I say I've got a basic problem with, would I risk, let's say, £5,000 for a couple £100 extra interest? Well, no, I wouldn't. And somebody needs to explain to me why that makes sense.
Roger Gewolb from the Campaign for Fair Finance and JDev Janardana, who's Zopa's chief executive.